All right, looks like we still have a few people coming in, but I think now's a good time to get started. I want to welcome everybody to our financial markets webinar presented by Beacon Financial Strategies. And before we get started, I want to go over a few housekeeping items. So this webinar is designed to be informative in nature and not to recommend as strategy or give any advice. There's a Q&A box down low. If you hover over the lower part of your screen, you'll see a place for Q&A. Please ask us some questions. We would love to hear from you guys. The host of this webinar is Aaron Campbell and Chip Heimiller, and I, John Motto, is the moderator. Other thing that I wanted to mention before I hand it over to Chip is that nobody's webcam or audio's on. So if you're eating lunch or just hanging out in your PJs, feel free. Don't worry about showing up on camera or anything like that. Without any further ado, I'll hand it over to Chip.
All right. Thank you, John. Really appreciate it. And thanks everyone near and far who's attending this webinar today. I really appreciate you guys taking time out of your busy schedules just to hear us kind of ramble on about what's going on in the markets. And but I can tell you that normally people get a little bit out of this, a nugget or two. And you know, our goal is to keep our clients informed with things that are going on and happening. And we firmly believe that having knowledge is power. And you know, with that message, I'll kind of go ahead and get started. So first of all, I would like to give everyone a little bit of a message of reassurance, okay? You know, markets are going to eventually recover. So never in the history of markets has there been a time where recovery has not happened. And, you know, so be assured that, you know, it will eventually happen. We'll see better days ahead. Right now, we're just kind of going through the motions of all this uncertainty, this kind of permeating the markets. You know, I always want to remind people that your portfolio is not the market. The market that you hear in the media and from your news sources is generally equity-based markets. You know, the Dow, the S&P 500. Your portfolio is much more diversified than that. And your portfolio is definitely not the market. So when you hear news saying, you know, the markets were down 2% today or 3% today, that doesn't mean that it's your portfolio that's down that much. You know, on the flip side of that, when the markets have big days, you know, if the S&P 500 is up 5%, then that's not necessarily your portfolio either. Just want to point that out. But also, you know, for any of our clients who are attending this, just know that your portfolio is developed and constructed specifically for you. You know, we go through the planning process. We know your situation. We understand your risk profile. We know your cash flow needs and all the things that are relevant to you in your specific circumstances. And all of those things are integrated in how we construct your portfolio. So just keep that in mind. Okay, I think it's good to talk a little bit about where we are right now and really why. And most of you guys know that at some point in 2021, inflation started to enter the system, okay? And this was caused by, you know, a number of things, you know, most of which are pandemic related. So, you know, as the pandemic started to materialize, the Fed kind of implemented a monetary policy of lowering interest rates at that point in time. Plus, there was lots of other things going on. There were other pandemic mitigation types of government actions that happened, right? The stimulus payments, I think there were 3 stimulus payments. There were PPP loans. There's very low interest rates. And so all of those things kind of led to economic growth, especially at a time when we really didn't expect that growth, right? The economy had kind of shut down a bit, right? So all of this increase in the money supply really caused some economic growth, which introduced some inflation into the economy. The other thing that has been happening, and this is not so much a function of Fed or government actions, but it's really a function of fallout from the pandemic, right? There's supply chain issues that's still happening. You know, certain areas of the world are still having major COVID problems. And so things like labor shortages, you know, there was a canal shut down at some point. So all of those things were kind of the perfect storm. And then now we throw on that the Russian-Ukrainian war, which is, you know, creating a lot of uncertainty there with commodity prices and what might happen there with, you know, Ukraine being a source of commodities for the world with wheat and other things, and also Russia. You know, we've put some major sanctions on Russia, and really the world has. And so, you know, that's, you know, when you take their natural gas and their energy and other things out of that system, then it's a change in the supply of goods and services. And when that happens, you know, inflation can happen. And so that's kind of what's happened now. And at this point, you know, the Fed's kind of taken some pretty assertive action, you know, and this chart kind of shows the history of Fed actions and what's happened. You know, you could see here where interest rates during the Great Recession dropped down, and then they held low for a while. And then the Fed started raising interest rates as the economy started to recover. And then, you know, we got to a good kind of stable point, and then COVID hit. And so it was necessary to really take those interest rates down to zero, essentially. And so recently, you really see this, the impact of the Fed's recent actions, and who knows what might happen there. I mean, the Fed's kind of come out and said, okay, we are committed to price stability, which means controlling inflation, okay? And so the expectation from us and many others is that we're going to continue to see some rate hikes. And the hope is that the Fed, you know, will kind of get inflation in check, and things will continue, the economy will continue to grow and that kind of thing. But, you know, at the end of the day, there's a heck of a lot of uncertainty, you know, and that's the thing. If you've been a client for a while, you kind of understand, okay, these are the things that create market fluctuations. You know, you see things like, you know, and people, investors ask questions. How high are interest rates going to go? What's going to be the impact on the housing market there? You know, is rising rates going to create price stability, eliminate or reduce inflation from the system, or will it, you know, just choke out economic growth and cause a recession perhaps? And so there's all types of questions that are happening. And whenever you see a period of time where there's tremendous uncertainty, the markets are going to be right there adjusting as well as new information arises. So I wanted to point that out, and you can tell here, I mean, what's happened. In the short term, stocks, US stocks and international stocks have both really taken a nice decline for this year, and bonds as well. Now bonds, you know, have taken a hit as well. I mean, just because interest rates have gone up, and existing bonds, and the prices decline when that happens. And so the good news there is, you know, my conservative investors are finally starting to say, oh gosh, well, interest rates are looking a little bit better. And that's kind of exciting, to be honest, but it's painful in the short term, I think. And so that's kind of where we are. Fortunately, longer term numbers look okay. And it is interesting to point out that, you know, the short-term results have a pretty great impact on longer-term performance as well. You know, just a few months ago, if we looked at the 10-year returns of U.S. stocks, it was you know, over 15%. And so now with the hit, we're have taken a little bit of a decline even on the 10-year numbers. But you know, that's kind of where we are. And you know, I think the future is bright, but you know, right now it's just kind of we're in this holding pattern, it seems. So what are actions that we need to take, or what are actions that we should consider, right? And I'll tell you right off the bat, you know, for investment actions, And I'm going to talk about the investment actions, and we're going to pull Erin in, and she's going to have some discussion on financial planning actions. But for right now, this is not the time to go and make major portfolio adjustments. You don't wait for a market decline to suddenly realize, oh, well, let's change our allocation to become more conservative. In fact, you kind of want to do the opposite of that, right? You see the market's declined a bit. Well, you really should think about it as an opportunity. And that kind of leads to my next action item point. Now, I'm specifically talking to accumulators here, okay? These are people who have 10 years or more until they need their money, okay? And so, if you're in the accumulation phase, I hope that you're like ecstatic, because, now's the time to continue your investment strategy, to if you have excess cash on the sidelines, maybe invest that, kind of put that to work. You've gotten like a 20% decline in equities. And so you have to think about it longer term. You have to know that, all of the noise and the, uncertainty is going to eventually dissipate, and, we'll start towards this normal trajectory of growth. But if you're in the accumulation phase, you should not be phased at all with this. This should make you excited and energetic and, keep it coming kind of thing. That's the mindset. I would say, rebalance your portfolio. Go into your 401k plan, hit the rebalance feature. Go ahead and do that. It makes a big difference now. So because what you're doing is you're selling those investments that have held up better than others. So you're kind of buying the dip. And so for accumulators, that's really the mindset that I need you to have right now. And believe me, that will pay off in the future. Now, for most of you, pre-retirees and retirees, and I would kind of say pre-retiree is a person who's maybe, 3 to 5 years away, and retirees are more of those, they're in retirement now, they're using their portfolio as a paycheck. And so there are a couple of things that I think that, you should consider, and things that we're looking at internally for our clients. One is rebalance your portfolio. Just what I said, you sell the investments that have done pretty well, and buy those lousy stocks that have, are down so far this year, and think that, okay, over the long term, that will be a good way to handle this. Also, one of the things, and I'm just going to mention it here, and then Erin's going to elaborate a little bit, is consider tax loss harvesting opportunities. Okay, so sometimes it makes sense to sell Fund A, bond Fund A, buy and realize a loss in that position, right? Because bond funds are a lot of bond funds have, if you've been in them for even a year, you've seen some declines and there's some losses, right? So, sell bond Fund A, realize the loss on your tax return, and then buy bond Fund B, just a lateral move. So you're simply just, making those trades to realize losses. The other thing I'd like to bring up is now's the time to consider upgrading your portfolio. And what do I mean by that? Well, it depends, right? So sometimes we have people who own mutual funds that they've owned for a long time. Well, mutual funds change. There's manager changes. There's change in investment strategy even. There's things like, maybe you have a mutual fund that has a higher than average expense ratio, and maybe you want to trim that fund to invest in a better fund. Well, now's a good time to do that, right? Because even if you have a fund where there's gains, maybe you have losses on other investments in your portfolio that we can offset that with, and just get you into a little bit of a better position in your portfolio going forward. The other thing is, I know a lot of people have legacy, what we call legacy positions, right? It's a stock that you've owned for, or a mutual fund even that you've owned for, 20 years. And maybe it's just a fund or a stock that you're overly concentrated in. And so maybe you just want to reduce some exposure there. Well, now's a pretty good time to kind of think about that. And, you just kind of have to take advantage of these periods of time because they don't present themselves very often. And so that's kind of what we're doing in terms of action items for clients and things. We'll reach out to you guys as our clients and touch base with you on any of these things. But I kind of wanted to go back to John and say, have we gotten any questions yet? Because I really want to make this beneficial for the participants who are listening in. Any questions so far, John?
Yeah, so we did get one question on, it's maybe a little bit of a difficult one, but one I think that is on a lot of folks' mind right now is, are we in a recession?
Yeah. So the funny thing about recessions is you really don't know that you're in one until after, 6 months or so after they've happened. And, I think that the economy is slowing. I don't know that we're in a recession. It's hard. We won't know until, we're at least 6 months into the recession, because the definition of a recession, by the way, is 2 consecutive quarters, economic quarters of negative GDP growth. And, I don't think the numbers have indicated a recession at this point. It doesn't mean we're not in a recession. A lot of times what we see is by the time it's been determined that there is a recession, we're already we're emerging out of the recession. And so that is a hard question to answer. If I had to guess, I would say no at this point. I think that, the economy has an awful large head of steam behind it, very low unemployment rates. Labor demand is up, for workers. And I just don't know that we're in a recession at this point. But who knows what the numbers will show when they eventually come out.
Right. Well, I think those were all the questions that we had for now at this midway point. I'll go ahead and hand it over to Erin, and she can kind of touch on the financial planning side of things.
Great. Thank you so much. Thanks, Chip, for all you talked about. So the point of my part of the discussion was just simply to discuss exactly what are the planning moves that you can make right now to be strategic during this time. And so Chip talked a little about accumulators and even pre-retirees. So those people just need to make sure that you're maxing out your 401ks at work if you have the cash flow to do it. The numbers for this year, 2022, did go up a little bit. So I'm reflecting that in this graph here. So 20,500. If you're over 50, it's 27,000. And so you just need to double check on your pay stub that you have increased those numbers. I always point out that the contribution limits don't include the company match. So just make sure you understand that the company match is in addition to that number. And then also that Roth IRAs and IRAs, they haven't changed, but if you have the cash flow to do it, you need to go ahead and contribute to your IRA and Roth to do that this year. So we'll go ahead and forward on to the next slide. So the next thing I wanted to talk about was just a little bit about the tax loss harvesting. Chip touched on this as well. So tax loss harvesting, again, is selling an investment at a loss. It's only in personal brokerage accounts, not in IRAs, not in Roth IRAs, things like that. But in your personal brokerage account, we can sell off investments at a loss. On the tax return, we can take up to $3,000 a year in losses to the front page of the tax return. So it offsets things like W-2 income or dividend income or anything else, pension income, Social Security. So you have a negative number on that front page of the return. If it's more than $3,000, then we can carry that capital loss forward, and that carries forward indefinitely. So we would just chip away a little bit at a time, either with other gains or $3,000 a year in losses. So that's an important thing to kind of take advantage of if you have losses in your portfolio. The next slide is talking a little bit about investment gains. And some of you are going, oh gosh, the markets are down. Chip just told us that the markets are down. Well, they are, but he also told you in that 10-year number that the returns have been up. And so you may have positions still that have a gain in it. And so it can be an effective strategy to offset investment gains with those losses like we just talked about on the previous slide. Or for some of you, if your taxable income is low this year, you might be in the 0% capital gains rate. So if you see those numbers there, 41,000 for single or 83,000 for jointly, the capital gains rate would be 0 up to that taxable income amount. And so it may be a good time to sell off gains too, or use them in combination with the losses. And so all of these little strategies are just a really tax efficient way to upgrade your portfolio, which is what Chip was just talking about. And so we just wanted to make sure you understood how that works. All right. Next, we're going to talk a little bit about my favorite subject, as some of you might know, which is a Roth conversion. We attempt to do this pretty regularly with all of our clients. And so basically the definition of a Roth conversion is we would take a taxable distribution from an IRA and move it to a Roth IRA with the idea that the future Roth distributions are not subject to income tax ever. And so all the investment earnings are tax exempt. A couple other things on this slide are just that there are no RMD rules for Roth IRAs. And then also that as distributions are made by your heirs, so let's say you pass away, you have a Roth IRA, they don't have to pay income tax on it as well. So this is a great planning opportunity. You're going, well, why are you mentioning it now? Well, if the IRA value is down, we can move money from the IRA to the Roth, and then hopefully the money will go up in value. And so we're kind of moving it at a low point in the market, which what we saw when we did this during the Great Recession, it was a boom for all of our clients who took advantage of this. And so don't think that Roth conversions are not a strategy this year. They definitely are. And I think on the next slide, we're talking a little bit more about the people who we would target for Roth conversions. So if you're temporarily in a lower bracket, maybe due to retirement or loss of a job or any kind of lower income situation, and you have unused deductions, and that's pretty common right now. The standard deduction is pretty high for most people. And so, a lot of people have a big standard deduction. They might have a big itemized deduction, say if they have medical expenses or charitable deductions that are pretty large. And so those are the people that we're going to target for it. And ideally it's after retirement, but before you start Social Security or before you start your required minimum distribution. So if you're in that range and we haven't, talked about this for you, maybe reach out to us. But I'm sure you're on our mind because these are the types of people that we're definitely targeting for Roth conversions this year. The next topic that I wanted to talk about is just I-bonds. We have gotten so many people asking us questions about I-bonds recently. And it's really kind of funny because we as a firm have been talking about I-bonds for years. And if you've worked with us for a while, you've probably like, oh yeah, I remember them talking about this. Well, we bring it back up because now everyone in the media is talking about it. We have a lot of clients talking about it. They'll call me up and say my parents were talking about it or my siblings or whatever. So I just want to kind of talk through what I-bonds are. They're savings bonds. They're bought directly from Treasury Direct, the website I've got on the slide. The interest is tax deferred until you redeem them. And so they kind of are like an IRA that way. They're tax deferred until you cash them in. The interest rate of an I-bond has two components. One is fixed, and it's fixed for the life of the bond. So if you buy a bond today, the fixed rate is 0. So you're always going to get 0%. And you're like, well, that sounds terrible. And it does sound terrible, but there are some bonds that are older that are out there that you maybe have 0.5% or 1% on the fixed component. The inflation rate is the other part. And so if you hadn't figured out already, I-bond stands for inflation, and inflation rate is adjusted every 6 months based on the CPIU. And so currently that rate is 9.62%. So that's why everybody's talking about it. Chip just told you that everything's down. Well, the only thing that's not down, or not the only thing, but one of the things that's not down is I-bonds. I-bonds are currently paying 9.62. But I just want to say that inflation rate is adjusted every 6 months. And so don't go in and buy that thinking you're going to get 9.62 for the life of the bond. You're only going to get it for probably through October, and then they're going to adjust it again. And so it could definitely go down. So I just wanted to point that out. The next slide talks about the pros and cons kind of that we see with the I-bonds. We talked a little bit about the pros, but I want to point out that I-bonds, you cannot redeem them in the first 12 months. And so they're illiquid. You just can't do it. You would, in the first 5 years you hold the bond, you would lose 3 months of interest if you redeem it in the first 5 years. And so that's kind of like a CD penalty for those of you out there who've invested in CDs in the past. The other thing is there's no paper statements, and you don't get those physical bonds like we used to get at the bank. So everything is done online. So if you're kind of hesitant about an online account, this is definitely an online account. And the website for Treasury Direct is not great. So I'll just point that out as well. Each person can purchase $10,000 per year. So you cannot buy them jointly. So if you bought one, your spouse could also buy $10,000. Typically, we'll tell people to buy them in small increments, $50, $100, $200, $500. And so we'll point that out. They're a neat investment. They protect against both inflation and deflation. They cannot go down in value. And so that's why a lot of people are talking about them right now. And if you have questions about them, reach out to us directly. We're happy to talk about if it would work for you. All right.
Yeah. And Aaron, I'll just chime in there that, when you're talking about the interest rate, just remember that it's the combination of the fixed rate plus the inflation rate.
That's correct.
Some people are get confused with that concept. So, we've seen people with fixed rates in the they have 4% on the fixed rate. Well, it's the combination of these two. So they're earning, like 13, 14% right now. So it just depends on, the timing of the purchase and where interest rates were at the time. I would expect this fixed rate to go up here in the next recycle set.
That's right. Thanks for adding that. All right. So I think at this point, Chip, if you go to the next slide, which we just did this one. Yep. So I guess at this point, we just wanted to kind of check in with John and see if there are any questions that we can answer, anything in the Q&A. So pull Chip back in as well.
Yeah, so we do actually have some really good questions here. One of the questions is about, for our existing clients, does Beacon go in and look at all these various strategies that we've talked about, rebalancing portfolios, upgrading portfolios, Roth conversions? Do we look at that for all of our clients? And I'll kind of take this one, and Chip, Aaron, you guys can jump in. We certainly do. We're looking at these kind of opportunities for our clients all the time. We talk about it in staff meetings, quarterly meetings. We're always looking to utilize these strategies that we've highlighted today to assist all of our clients.
That's right. And I think we did go in and rebalance. Have we rebalanced everybody just about in the Beacon clients, just about?
Just about everybody. And if we didn't rebalance, there was definitely a certain reason why we decided not to go in there. But we looked at all the accounts. Okay, great. All right. Any other questions? So this one I think I'll give to you, Aaron. Okay. Should everyone buy I-bonds? So, well, we talked a little bit about what the pros and cons are. I think if you have extra cash, or you're wanting to kind of get a better rate of return on your emergency fund, knowing about the 12-month illiquidity, I think it can be a good purchase. There are some reasons why you shouldn't, but I definitely just want to reiterate that the temporary interest rate is 9.62. And so we don't expect that to continue on. If inflation, the CPIU, goes down at all, and that doesn't mean we're in a deflationary, inflation is calculated as an increase, right? So we could just plateau and the inflation rate might be, 1 or 2%. So just as you kind of see that, then we might see rates fall. But I think Chip's right, the fixed rate should go up. And so maybe that's a reason to wait to buy some after everything resets in October.
Well, yeah, and I think, the Fed is actively seeking to stop the inflation rate, right? And so, that's one of the things that they're trying to control. So our expectation would be that, that inflationary component of an I-bond will certainly decline. Now, I don't know when that is going to be. We talked about how complicated and our economy and really the global economy is. And so we don't know how long that's going to be, but it'll happen eventually. And so, yeah, I expect the November fixed rate to be a little higher than zero for sure. And, but we'll see. It'll be interesting to see. I actually don't let that deter you. If I-bonds is something that, works well for you and your overall strategy, and we've talked about this with most clients, but go ahead and get the ball rolling on that. But, and you can give us a call if you want us to help you, assist you with that. But it is one of those things we'd like you to consider at least.
Right.
Well, we did have one more question. I'll give this one to you, Chip. And this is another tough one, I think. How long after a market downturn like we're having right now does it typically take for there to be a bounce back?
Well, it depends. I kind of anticipated this question, and I'll forward to the next screen. But I think we showed here in the past, and I think maybe the video might be covering up some of the numbers, so I'll just kind of read it out. But by and large, it varies. It varies. I mean, you can see this top one up at the top of the screen here is the Great Depression. Well, that lasted a pretty long time. I think it's 151 months, from the recovery to have kind of happened. So, but if the COVID recession were in here, it's only like 4 months for the COVID one. So it really varies. And, every market downturn is a little bit different. And so we have to be prepared to wait it out. And so, absolutely. So, I don't know that that's a good answer, but it is, I think the average is, maybe 20 months or something. But, again, everyone's different. The Great Depression numbers, and the Great Recession numbers more recently, really skew some of the other more run-of-the-mill types of market downturns. So I think that's an answer. And I just saw another one come in, and Aaron, I think this one you should answer, but I think you can answer this one. At this time, should I consider starting Social Security rather than waiting until age 70? I think that's a great question, because we probably brought that up in a meeting with individuals. Is that's an option. If you're beyond full retirement age and you're choosing to wait, should you go ahead and take Social Security?
Yeah, and I mean we do bring that up, because if the accounts values are down and you're taking distributions while the accounts are down, then you may want to consider it. Typically what we'll do is measure it, but I will say that if you're beyond full retirement age up until age 70, if you are delaying Social Security, then you're getting an 8% increase every single year you wait. And so it's kind of like if you leave Social Security alone, it's continuing to grow. So it's kind of weighing the balance of the two. So, I mean, specifically, if that's the question, then we should probably just take another look at it and analyze it specifically for each person and make sure that it makes sense and everybody feels comfortable for the decision. But yeah, Social Security is always on the table for everyone if they haven't taken it yet as a possibility. So it's definitely one that we would want to take on a case-by-case basis.
Yeah, and it's a lot of other, complicating factors there. Everything from, what's your how much money do you have, overall? What's your asset base? Do you have other sources of income? Do you have long-term care insurance? All those different things kind of play into that decision, and it's very customized and specific to each individual. So I think that's great. Any other questions, John?
No, I think that's it.
Okay. Well, I want to, again, thank you guys for taking time out of your busy schedules to hear just our general thoughts and give a perspective on where we are and kind of maybe clarify and hopefully you gained a little bit of knowledge there and maybe or have a little peace of mind from that. That's really what we're going for. But if there's anything specific that we can answer for you, please don't hesitate to reach out. We're here every day. I don't want you to worry. And that's our main objective there too. But, we feel good about where things are long-term for all of our clients. And we really hope that you do too. And but on that note, we'll go ahead and end it and bid farewell for now. And hope everyone has a great day.
Thanks so much, everybody.